Hey traders, welcome to Charts and Coffee. It's kind of dark in here. All right, it's all right. Welcome to not our Charts and Coffee. Well, it's kind of Charts and Coffee because I am doing a little bit of iced coffee this evening. So welcome to our weekly Raghee report. Great to see everyone. Hope everyone's had a great weekend. Hope Sunday's been at least relaxing. And then as we get into our show, let's get a little productive here. Take a look at what's going on in the market as we open, get a good look at what we're dealing with as we go into this week. Jackson Hole on Friday, Powell on Friday, and this is setting up really nicely for the pullback that I'll be looking for. So I'm sure throughout the conversation we'll get some questions about buy the dip. If we don't, somebody just type in, Rog, what's that mean? We'll take a quick look at it. And we want to, I do want to take a quick look at the calendar. In terms of what we are dealing with, and here, let me pull the calendar up here. In terms of what we're dealing with this week, there's really probably nothing more impactful than the Jackson Hole, Wyoming event Friday. I think what's also going to be interesting is what do the Fed fund futures target rate probabilities look like going into Friday? And then what do they look like after Jerome Powell has spoken? And then what are the adjustments that ultimately we're going to see that are made? All right, so let's take a look. When we scroll through the calendar here, services PMI, again, not something that I would ignore, but who's going to want to step out in front of whatever it is that Jerome Powell is going to say on Friday? So I'm not saying we're going to stay range bound. In fact, if anything, we could see some weakness going into Jackson Hole, which I would absolutely welcome, because that dip, that regression to the mean, that pullback that we're looking for, we'll talk about here tonight. But there are some pretty important numbers that we're going to get. Core durable goods, you can get into preliminary GDP, and then Thursday starts Jackson Hole. Jerome Powell speaking on day 2. So on Friday, big time hot zone, big time caution day, 10 a.m., Jerome Powell. And then we're winding down the month. So month end of month shenanigans as we go into the fall trading season. It will not be a boring week. At least it won't be a boring Friday anyway. All right. So let's go ahead and dive into some of the questions here. Let's get through as many of these as we can. All right, Nick, how are you? Hope you're having. I am having a great weekend. Reading some new books. So I'm trying to see where they are. I put them on the bookshelf. Actually cleaned up the bookshelf over the weekend. So I'm trying to clean the office up. The office has been absolutely a mess through summer, getting everything squared away for fall trading season. We're getting ready for a class in November. So let's see, about 2 months away from that. So a lot going on in the next 60 days. Very, very excited. All right. So yes, it was a terrific weekend, kind of getting these last few months of the year planned out. When you want to trade oil, what tickers do I use? All right, so let's talk about oil directly. CL is the full-size contract for oil. For day trading, I recommend C oil for most traders who have some experience with the leverage and the speed and the dollar-based risk of a full-size futures contract. If not, there is MCL. This is the micro crude. So it moves just like the full-size contract does, but it's 1/10 the size. So 1/10 the risk and 1/10 the reward, because it's 1/10 the contract size. And what's great about micro contracts is it allows us to control risk with one of the most basic factors of risk, which is the number of shares, the number of contracts in the case of futures, additionally, the contract size. We can then think about USO, which is the crude oil ETF. This is not as liquid in terms of the option chain as it once was. To buy the underlying USO, to short it, and plenty of liquidity there. But the option chain can be very spotty. So be careful when you're looking at USO calls and puts in terms of how much open interest is at the strike that you're interested in. Now, I know crude oil then opens the door to oil stocks. So keep in mind, Nick, XLE, OIH, XOP, those are all going to be related to crude. And then we keep going down the energy list. Now you've got RBOB gasoline and natural gas. And then you've got the FCG natural gas ETF. So you can keep going down the line with that. But that's the crude oil breakdown. Thanks for the question. And I love the choose your own adventure part of that, Nick. In other words, what are all the alternatives we have access to when we are futures, not trading futures, not just being a futures trader, but understanding the touchstone market of the crude oil futures, and then looking at all the ways in which we can express that idea, whether that be options on the futures, a micros contract, or even the ETF and stocks. So awesome question. Hey there, Mr. Walker. Do I use a combination of volume ledges and Darvis levels to determine the point of validity? So the point of validity, Mr. Walker, is its own thing. It doesn't need anything else. Could I confirm the importance of a point of validity with, let's go to the S&P, for example. So there can be a point of validity on the intraday chart, on a daily time frame. Heck, there can be a point of validity, point of validity on a weekly, right? So let's talk about what a point of validity is. A point of validity is a price and technically based stop loss. And the reason I call stop losses points of validity, for those of you wondering, Rag, what is that term? It's a Ragheeism. It's something that I coined back in my third book. And I shared that because stop losses are moved around a lot, because stop losses are usually very, kind of randomly placed, either by some random percentage or a dollar amount. And because it's not expressing anything other than sort of just a random risk, I'm willing to spend or risk $500. Well, why not six? Why not 550, right? It's very negotiable. And that's oftentimes what happens to a lot of traders. So I started saying, because I was susceptible to that too. So I said, all right, what's one way in my brain and my thick skull I could remind myself I placed that stop there for a reason. And that's why I started calling them points of validity. So with that being said, that's the volume ledges, very important. Darvis level, support and resistance, very important. But it really depends on the trade. Mr. Walker, is it a trend trade? Therefore, when is the trend no longer valid? Is it a fade of a ceiling or a floor? Then it is, where is that ceiling or floor no longer containing prices within the range? So you really have to know the underlying strategy and then ask yourself specifically, where is that strategy no longer valid? And if you find yourself using volume levels and Darvis, that's perfectly fine. But always know why you're getting in, because then the why I'm not going to stay in becomes an easier question to answer. All right, next up. Thank you for the question. All right, I'm not topspin. I'm not even sure what that means. Let me read that question. Task. Oh, I don't know if that's to somebody else. Okay. I'm not even sure. Topspin? Maybe it's a Sunday evening and my brain synapses aren't firing, but I'm not even sure what that is. It's a little too cryptic for me. Scan, find AZN and MA 200. I guess double green squeeze. Okay. Could you rephrase that one for me? I'm happy to answer the question. Too many moving parts of that one, Topspin. All right. Crowd. CRWD. The uptrend just organized. Oh, it's a scan that you actually posted? Okay. All right. Well then, moving on. All right. Crowd. Okay, Stacy. Double green, sitting on the 200 propulsion. The 21 propulsion. And we have a little bit of a Darvis ledge right there, kind of going back to Mr. Walker's question, you can see a volume ledge there. It's not the point of control. That's the most volume we've seen since this year, right? Very close though, really close. So you've got a point of control just below the low from Friday's candle. You've got the 21 propulsion sitting there just above it. Neat zone. I would say it's a very cool zone. But here's the thing. It's been very volatile, even though it's grinding higher. It's a very fresh uptrend. Does make sense. Be very cautious about scaling in. But I think this is something you could scale into, but wait till after earnings, right? Notice where we are in terms of that countdown to earnings. If I am within 2 weeks, I'm not going to enter. So if we're still able to keep that uptrend, and it's a very fresh one, if we're able to keep that uptrend after earnings, I'm game, Stacy. So the reason I'll say no is not because you don't have the trend, and the wind at your back, beautiful, but that proximity to earnings is kind of the no-go for me. All right. Topson says, smash that like button. I appreciate that, friend. I do. All right. Thank you very much. Jackson is Thursday and Friday. It is, Anna, but remember, Powell's only speaking on Friday, and that's what everyone is waiting on. You're absolutely correct. Thursday and Friday, day 1, day 2, but day 2 is when Powell makes his appearance. All right. Next up is Stacy asks, double green by the dip. Oh, so kind of following up on the earnings. So Stacy, if I rarely do it. So here's a process that I would consider. First of all, I'll use a service like Estimize. That's my preference, estimize.com, Estimize. And I'll usually look at what the whisper number is for earnings. I don't use previous earnings. I know a lot of folks like to do that. Gang, just because earnings were usually beat doesn't mean they always will be, right? In fact, that's actually, in my opinion, it's measuring the wrong thing. I don't care what earnings history really is. That might be a second, third, fourth consideration. The first or second consideration is going to be what was the, whatever the different consensus is. What's the company guidance, if there is any? What's the whisper number, right? And then I'll look at something that's a little bit more akin to what used to be called force rank. It's more of a crowdsourced whisper number that's far more accurate than, say, an individual broker or an individual site saying this is the whisper number. So that's what Estimize does. It's a little bit more along the lines of an old force rank. So I look at that crowdsourced whisper number, which is oftentimes going to be different than the consensus that we see. I'll take a look also at the expected move, and I'll do that via historical daily price movement ranges. So once I've looked at all of that, then I ask myself, Stacy, where is the whisper number in relation to either the company guidance or the sort of more widely held consensus? What's the chasm between that? So I look at the estimized number versus the other numbers. That estimized number is the one that I'm looking for the market to beat. And if that estimized number is lower than, say, the consensus or the guidance, and I'm seeing a lower price on, say, CrowdStrike, then my expectation is that lower crowdsourced number, if you will, is what's been discounted. I know it's a little difficult to explain out of, sort of the timing and context, but I don't look at previous earnings. I don't look at the history of earnings. I think it sounds really logical to do that, but that's not why a company stock moves on earnings. Earnings move for the same reason any hot zone, including earnings, move. What did we expect and what do we get? It's the chasm between the two that causes the volatility. So the more that I know what was discounted into that earnings event, the more I can understand why that stock is going to move. So the history of earnings is very, very low on the totem pole of importance. Because again, no one's saying, well, we usually beat, so let's beat again. That's not a setup. We're just using sort of a tendency, and tendencies are not trades, right? So it's really got to be the difference between what's actually baked into the cake and what do we actually get? So those are my thoughts on earnings. I hope that helps. All right, what is the best way to buy the dip? All right, so let's get into it. Buy the dip. So there's a few steps, and I'm glad you asked. Because I think there's a lot of confusion around what the heck does buy the dip, right? And I'll move this into this view. What does buy the dip even mean, right? I think it's turned into a meme. It's been sort of reduced to becoming a meme, which is really too bad because it's a very important concept. It's the root of my trend trading for 30 plus years. What's the dip? By the way, gang, the dip is the same thing as we could say the regression to the mean. We can call that a pullback. We can call that a retracement. And that just means that for different different traders who use buy the dip as their sort of battle cry, we're going to have different measurements. For me, that measurement is predominantly the 34 EMA wave and 21 propulsion. That's going to be the way that I look at buy the dip, the 34 EMA wave and propulsion. And the most important thing is, this is the most important thing, there is no such thing as buy the dip without a trend. So when folks say buy the dip and the market's in chop, doesn't apply. When folks say buy the dip and the market's in a downtrend, oh gosh, no, right? Just big cup of nope. So let's use that CrowdStrike that Stacy mentioned. I'll show a couple other examples. First of all, is there a trend? Yes, otherwise there's no buy the dip. Where's the 21 EMA? Where's the wave? That's the dip. Let's say I take a look at the S&P. And by the way, gang, if you're curious about this, I did a video on Thursday, or was it Tuesday? It's a blur. I called it buy the dip is back because the trends are back, right? Because the uptrending structure is back. Now, this is what, in terms of, there's a lot of folks that think, well, the markets are going to head lower again. My question is why, right? Because a secret squiggle said so. You notice I'm not saying the market's heading higher only because of the wave. If you've been following my analysis for the last almost 2 months, I said the bottoming process, meaning the downtrend was over. It doesn't mean that there's an uptrend resuming. It simply means a downtrend is over. And we said that on the 7th of July. And that, in fact, was true. This is not about my predicting the market. Actually, I kind of really, not so secretly, loathe that. This is what the market's going to do in November, and this is what the market's going to do in March of 20. Please, I don't even know what I'm having for dinner tomorrow. I'm not going to predict what the markets are going to do 4 weeks from now. Structure dictates strategy. Strategy dictates the indicators. So my structure is an uptrend. But remember, the uptrending structure that got us talking about an uptrend, or at least stopping the downtrend back in July, was that we have the clearest, most stable, and frankly, less hawkish picture ever of where the Federal Reserve is taking rates. Remember, gang, the market completely blew off whatever recession now means. Remember, we redefined that. I don't even know what it means anymore. I don't even know what, does anyone know what the new definition is? So that being said, the market doesn't care about recession. It just doesn't care. We also see that the M2 money supply has been falling, and that CPI historically follows that. We've talked about that in previous episodes of Charts and Coffee, and I think even in our weekly show. Let me show you this because this is really important. So when folks think that the market can make lower lows, my immediate question is, well, why, right? What's the reasoning for that? Let me hang on. I got to find this image. Give me one moment and I'll find this image because this is really important. And the reason it's important is because it allows us to understand that if the inflation numbers are not likely to keep moving higher, right? And where is this? It's such a cool image. If they're not likely to keep moving higher, then what reason is there for the Federal Reserve to continue to be super hawkish in their messaging and in their monetary policy? This is the inflation follows the money, right? Look at that M2 cyan colored, whatever you want to call that, aqua. Now look at that reddish maroon color. CPI follows the M2 contraction. That's the money supply. That's huge. That's huge because that then tells us the Federal Reserve doesn't have as much to be hawkish about. If they're less hawkish, why are equities going to sell off? Right? What's the catalyst for that? Especially since we've organized into an uptrend. Now, of course, unforeseen things can happen, right? But we've gotten above the 200 propulsion. We have the double green. So buy the dip is in this environment, not just finding a technical uptrend, which by the way, we have north of the 200, which also we have, but also what is the macroeconomic trend? And the macroeconomic trend is going into December, we are highly likely to peak and plateau in the target rate probability. So that means the Federal Reserve is going to be done hiking rates in December. I know it. You now know it. We all know it. So if we know it, what's next? Well, what's next is now all the speculation as to when they're going to start to cut rates, right? Do I want a pullback? Yes. Could there be a pullback with Jackson Hole? Absolutely. Could we have another tick up in PCE or CPI, which sends the markets lower? I sure hope so. The way, though, that I'm looking at the pullback, what's going to be my pullback for the S&P? Right around 4125, 4120 to 4100. That's what I'm, not 4100, sorry, 41. Yeah, 4125. Yeah. 4125 to about, 4100. So really the point of control, which is right there, right? Your point of control. And you know what? I must have, oh, you know what I have? The labels are, I hate that. There we go. I don't like when they stack up and they're not in line with the y-axis there, or the x-axis there. Anyway, 4120 to about 4100. That's what I'm looking for. Look at that volume ledge. That's the spot, okay? That area right in here. I'm going to put another little drawing tool. So that's what I'm looking for. That area. And it starts the 21. Heck, it could even start aggressively at the 200. The 200 propulsion. If I can get about 3 dots, 5 preferably, that's in play. So I need the weakness, but that's where I'm expecting it to likely get pulled down to. And then take a look here. That's right there, essentially my point of control. I really want to see prices stay above 40.70 because then we will have broken the wave. We're likely going to then move back into chop, and that changes the strategy that we're going to use. But I'd still be bullish. It just won't be an uptrend anymore. All right. So that's an example of the way that I want to buy the dip on the S&P. All right. Next up, Embass asks, Schwab, you got it. So Schwab for a bearish swing on the daily. So if it's a time frame other than the daily, let me know. But on the daily, no, my friend, no, there's no bearish swing here because look at the bottom of my screen. Schwab, double green. In fact, let me do this. Let's compare it to the XLF. XLF is double green. Schwab is double green. So I do not have any reason to be anything but bullish on pullbacks. And then once again, there's the 200. There is the 21. And then I love that. That's a great volume ledge right there. Look at that volume ledge. And let's see what it would be at the beginning of the year. Oh, awesome. Yeah, same area. Look at that volume ledge right there. Yes, the point of control is way down there. That does not concern me. This is the zone. And this is the zone right in there that I am looking at. Right in there. Okay. Okay, next up, what about QM for oil? So CL has a half-size contract in the QM. I believe that one is a mini, is the way to look at it. So you've got CL, the full size, you've got QM, the mini, and you've got MCL. I don't believe QM has that much liquidity. I do not know because frankly, Anna, I do not trade anything but the CL. Micros were not part of my life early on as a future trader. I think they're wonderful, and I hope they keep coming in terms of more micros. Bonds would be a great market to have micros in. There's a number of, I'd love to see micros in, gosh, bonds would be great. Natty gas would be another one that would be great to have micros. I will be absolutely shocked if we don't see more and more micro contracts from the CME. I don't use QM. I think it's a little illiquid, but if it has good liquidity, go for it. Go for it. I have no problem with that at all. If it's coming now, the bot tells me micros are coming for bonds in November, and I do believe check the open interest and volume on QM. I think you'll notice it's really thin, and if it's thin, we don't want anything to do with it. All right, next up is a great question, by the way. I love it. Good afternoon. Hey, evening. Yep. Sun's setting. It's getting dark here in the office. You can see the sun behind me, though. All right. XLRE looks double green. It is. Yep. These are a lot of fresh double greens, gang. One of the things that we've been doing in the Sector Secrets Mastery. And by the way, if you want to join me for my day trading, for my swing trading, like we're talking about here, and even my position trading for my longer term portfolio, we do all of that over in the Sector Secrets Mastery. You can learn about it at sectorsecrets.com. And XLRE is on that double green list. We've been building a watch list now for 2 weeks, and it just gets bigger and bigger when it comes to all these uptrends. It's actually difficult to find a downtrend right now. So do we have to watch out for interest rate effects on the sector? Again, if we know where target rate probability is heading, look, mortgage rates are already reflecting what we're expecting to happen. So no, my theory is this. The more I see everyone I mean that generically, the more conversation happens on television, the more conversations that are happening online, etc., about a big drop coming. Remember this, gang. And then, think about this. Think about recent memory. Does a drop ever come when we're broadly expecting it? Usually no, because if we're talking about it, we've already usually discounted it. Discounting meaning if I'm talking about a drop, my portfolio probably has puts in it. I'm probably already short. It's my opinion is already expressed through trades in the market. That's what it means to say that it's already been discounted. Why would we start to see more of a drop unless more and more people adopt that same attitude, which is entirely possible? I have found throughout my career, though, the more the discussion is about a drop to come, the less likely it does. I've been hearing about the market is going to drop once the fall trading season starts. Maybe. Again, let's just trade what we see, right? And I love what you're seeing there, XLRE. It's above the 200. It's testing it right now. 200 is valid. The 21's valid. Got a slight ledge here around 43.80 to 44. But I would not be as concerned about rates unless the Fed target rate probability veers wildly higher than 3.5 to 3.75. No, I do not anticipate that affecting XLRE, XHB, or even ITB for that matter. Okay. Let's see. Heather Call how many hours a day do I give to the market? Depends on the day. I like to day trade for an hour in the morning. We do that in the Sector Secrets Mastery Room. Those of you that join us Monday through Friday, 9:20 to 10:35, that's my favorite hour of the day to day trade. I like to put in another hour or so a day to look for swing trades. And minimum is probably going to be an hour if I'm just going to day trade, 2 hours if I want to day trade and swing trade. So minimum 2 hours. And after that, it's really up to me as far as how much more time I want to spend. But I'd say minimum 2 hours if I want to day trade and swing trade. If you want to do one or the other, about an hour a day. But it's going to be a good hour, right? It's going to be about a good hour a day. So that's my feeling on that. How much time do I dedicate? And it depends on what strategies I'm scanning for in the market. So I hope that makes sense. All right. Next up is, can we double dip Google? I don't know what you mean by double dip. Um, it's not double green. So I would avoid Google for now, Mr. Walker. Keep an eye on XLY though, and this applies to Google or Google. Keep an eye on XLY. I would keep an eye on that one. I think there's some better stocks in XLC than Google or even Facebook for that matter. XLY is interesting. XLK is also pretty interesting. All right, so um, Topspin asks, using the eyes to scan, found MA, but what am I missing? It's a nice double green. It's a nice double green. You know, if you're looking at a double green by the dip, yeah, that's a good one to look for. It just, so what I would say is the cleaner the uptrend you can find. Now, of course, if you reverse search MasterCard, you know where it exists within the XLY. And so if you can do a scan of not just MasterCard, but the broader sector and then individual stocks, and then MasterCard's the one that stands out, then go for it, Topspin. Yeah, then go for it. Yeah. So no, I don't think you're missing anything if that's what has come up as far as preferential treatment of uptrends is very important. So I like what you picked out there. Yeah. Now we need a dip. Eric asks, hey, RH, do I ever pay attention to dark pool prints? Not even a little bit. No. Remember, gang, there are a lot of ways to scan for different volume levels. I'm going to look at the volume ledges. They say up to 40%. FINRA says up to 40% of activity in different stocks can be these dark pools. They do have to be reported. They can be found. There's lots of services that'll find it. It's a pretty easy automated thing to find. It's not terribly difficult. It's another way of looking at volume. Back in the day, having done this for 30 years, there's always different sort of volume that seems quote unquote hidden. Back in the day, it was block trades, right? Trades of over 25,000 that could get reported at least by 4 p.m. They did not have to have real-time reporting. So we've dealt with different versions of volume that doesn't seem to be visible. It's never affected me to not know, and I think it's made way too much of. It's not going to override the underlying trend. It's not going to override the underlying support, right, of Darvis. You want to watch volume in a really effective way, and if you want to know where these executions like to take place, this is why about 3-4 years ago we did a class called Submarket Sonar. We started talking about what are the ways that I can break down volume profile. What are the ways that we can break down volume weighted average price by anchoring it, an anchored volume weighted average price, and how do we look at the standard deviation of volume weighted average price? Because the way in which these large orders tend to be executed is near the VWAP, right? So no, I it's never been something that really concerns me in any way. I'm not missing anything by not knowing where they are, and they're easy enough to find. If I want to know where some of the big prints have been, there's a number of services on the web that you can go get that data. It's definitely not hard to find. All right, what's going on with healthcare? Healthcare is a laggard out within the S&P. Healthcare is a laggard. And if I'm looking at the S&P, while I like the dip, XLK and XLF for better uptrends. So if you want to find the relative outperformance in the S&P versus, say, the ES or the SPY, remember your outperforming sectors within that index are not, to your point, it's not healthcare. It's a bit of a laggard. Now, I do like the idea of it playing catch up. And I do have, for those of you in the Sector Secrets Mastery, we have a setup on this in case it does sell off and then wants to play catch up. So I kind of like that setup. It's very affordable. The other two sectors are not near a trigger entry for us. but XLY is not too bad. So for those of you in Sector Secrets Mastery, check out the alert that I sent out on XLV specifically. And just like that, gang, I've run over about 5 minutes, but thank you as always for joining us for our weekly Raghee report, sharing what I do, sharing what I know. 30 years of playing this game, gang. I know a lot of things seem new. I'll tell you what, though, it's really just an evolution of the old, right? A lot of things just, they come back around, but with a slightly different form. Just focus on the trend. Focus on risk first. You know, we could definitely have at some point, we really should have a really in-depth, risk reward conversation in the future, because I find a lot of traders taking some severely upside down, ridiculous risk for very small rewards. And I found this old image that I've had for myself, right, to remind myself. So, that's something that I'll leave you with here for today's show. As always, gang, thank you for being here Sunday evening. I know who my hardcore traders are, getting ready for Monday on a Sunday evening. You are my kind of people. We're cut from that awesome cloth. We want to win, right? We want to win. We do what it takes, and I love it. I love that. All right, gang. Thanks as always. I'll see you all in the Sector Secrets Mastery for our Monday through Friday day trading, that 1 hour of the day. I'll see you in Charts and Coffee at 9 a.m. If you have any questions, feel free to leave them in the comment section. Thanks as always for smashing that like button, and I'll see you tomorrow.